ACTG 201-01 covers the principles and fundamentals of accounting, and to quote the course description, it's an introduction to the theory and application of accounting. This course covers double entry accounting, the accounting cycle, merchandising operations, control accounts, and subsidiary ledgers, internal control, cash, short-term investments, accounts receivable, merchandise inventory, plant assets, current liabilities, long-term liabilities, payroll, financial disclosures, and partnership accounting. To go more in depth, I'll be summarizing the key points we learned in each chapter of Horngren's Accounting 13th edition. In Chapter 1, we learn accounting is defined as the information system that measures business activities, processes that information into reports, and communicates the results to decision makers. Also, why accounting matters and how GAAP, generally accepted accounting principles, makes reports uniform and comparable, as well as the accounting equation, which is assets equals liabilities plus equity. Equity being owner's capital less owner's draw, plus revenues minus expenses. Chapter 1 also covers preparing financial statements, and then in turn looking at those statements and how to get a business's ROA, which is equal to net income divided by average total assets. When we cover Chapter 2, we dive deeper into the accounting equation, further cementing it, learning about debits and credits and normal balances. These may take a bit of time to understand because double entry accounting and T accounts are a completely different way of viewing finance than what most people are used to. However, it's the cornerstone of modern accounting. Once you start understanding, it'll make sense why it's done this way and the brilliance of this method. We will then learn to record transactions in our journal, after which we post those journal entries to a ledger. We are then told about the trial balance and a list of all ledger accounts and their balances at a point of time. Lastly, we learn about the debt ratio, which is equal to the total liabilities over total assets. Covering Chapter 3, we read about accrual basis versus cash basis accounting, and why GAAP requires accrual basis due to the matching principle. We then learn how to post journal entries needed for accrual basis accounting. Then, Chapter 3 shows us how to make adjusting entries and their effect on the financial statements. In the book, we are taught the use of worksheets that summarize data, making it easier to prepare those financial documents. In Chapter 4, we cover the preparation of classified balance sheets, as well as going over the post-closing entries, and then the accounting cycle, which begins with the starting balances, then journalizing transactions as they happen, posting those entries to the general ledger. Then, at the end of the accounting period, we use the trial balance to create a worksheet to make sure the debits and credits balance, the logging of adjusted entries for accrual and deferrals. After that, we create the financial statements, and lastly, close out the revenue and expense accounts. This is repeated for the next accounting cycle. Lastly, in Chapter 4, we learn about the current ratio, which is equal to total current assets over total current liabilities. Chapter 5 is the first of 2 chapters on merchandising operations, businesses that buy goods and products to resell to customers, businesses such as Costco, Walmart, Sportsman, etc. We learn about the perpetual and periodic inventory systems, as well as how purchases and sales are accounted for in each system, and also the financial statements relating to merchandising operations. We then go over the gross profit percentage. This percentage is equal to the gross profit over net sales revenue. With Chapter 6, we learn more about merchandising operations. First, we go over some accounting principles like conservatism, the consistency principle, the materiality concept, and so on. Then we explain the 4 ways to calculate inventory costs under a perpetual inventory system. Specific identification, which is used with vehicles, expensive machinery, and high-end jewelry. FIFO, which shows higher income, drawing investors, and benefits the business with better borrowing rates. LIFO, which shows less taxable income, which is more common in economically turbulent times. And then lastly, weighted average, which is a middle ground between LIFO and FIFO. We also learn when and how to apply the lower cost to market rule to your inventory. Then, inventory turnover and day sales. which help us understand how long goods sit on a shelf before selling. And then it also touches on inventory costs for a periodic system. Chapter 7 is about accounting information systems, such as QuickBooks or Sage, and what makes a good one. We also learn in this chapter about special journals and subsidiary ledgers. In Chapter 8, we learn about internal controls, which are plans, measures, and rules to safeguard assets, encourage company policies, promote efficiency, and ensure accurate and reliable accounting records. We also learn the cash ratio, which is cash and cash equivalents divided by total current liabilities. Chapter 9 is about accounts, notes, and other receivables. We're shown how to journalize sales on credit, what bad debt is, how to safeguard against it, as well as the different methods of dealing with it. It covers notes receivables, their terminology, and how to calculate interest on them. The ratio we learn in this chapter is the acid test ratio, also known as the quick ratio. It's the ability to quickly pay off liabilities if they become immediately due. It is equal to cash, cash equivalents, short-term investments, and net current receivables over total current liabilities. We're also acquainted with AR turnover ratio and the day sales and receivables ratio. Chapter 10 is about PP&E, natural resource, and intangibles. It first covers calculating the full cost of PP&E, then depreciation through straight line, double declining, and units of production, then the depletion of natural resources with units of production, and then the amortization of intangibles over time, and then also when and why intangibles become impaired. Chapter 11 is about current liabilities and payroll. We learn how to account for liabilities of known amounts as well as liabilities that must be estimated. We are shown how to calculate and write up standard payroll with gross pay less withholdings to calculate an employee's net pay, also known as take-home pay. Then, the taxes on top of that the business is also required to pay. The last things in Chapter 11 we learn about is contingent liabilities and the times interest earned ratio. Chapter 12 is about partnerships and the articles of partnerships that come with them. How to prepare statements for partnership equity, divvy out profits and losses, dissolve the articles and recreate them upon new members joining and old partners leaving. And lastly, how to liquidate a partnership. We don't cover Chapter 13 about corporations as it's not in the scope of atcg 201 financial accounting. The last chapter we cover is Chapter 14. It's about long-term liabilities. Reading ahead, we'll cover the journalization of mortgage payables, long-term payables, and bonds payables, as well as reporting liabilities on the balance sheet. And then also, we'll learn how to use the debt-to-equity ratio, which is total liabilities to total equity. So in conclusion, ACTG 201 Financial Accounting covers 13 chapters of Horngren's accounting, and is an excellent course if you want to understand your accountant better, are thinking about going into the field of accounting, or just love numbers, finance, and logic. Not to mention, it's taught by the kind and caring, but strict, instructor Ronnie Laudati.